Hello and welcome to the Business Today show. I'm Udayan Mukherjee. With me is Abha Bakaya and our guest for today, a very old-timer in the market, S. Naren, who runs a very large corpus of money at ICICI Prudential Asset Management Company, one of the largest fund managers or mutual fund houses in the country. Naren, great to have you on the show. And, we'll talk a lot about the stock market, but I want to ask you about how you're feeling about various asset classes now and the interplay between them, because you do run successfully many multi-asset funds. And it's an interesting time for these multi-asset funds because there is uncertainty in equity. Interest rates could be changing around, which is very germane for the debt market. And gold has been rising because of the global uncertainty. How would you allocate money between various asset classes in the light of these changes today?
Actually, it's a very interesting time for multi-assets, primarily because every asset class goes up and down. So, if you look at bonds in the very recent past, bonds have done well. No one would have believed that yields will drop, but yields have dropped in the last few weeks, the last week. And there were times when gold did well, then there were times when equities did well. So we are in a period of time where there are times when gold does well, there are times when bonds do well, there are times when equities do well. So you have a situation where something like multi-assets, where different types of assets are there in the fund, and you have different types of equities also, which is value or growth and quality, does well. It becomes much more interesting because different asset classes tend to do differently at different times. So it reduces overall volatility of the whole, and that becomes more interesting from an investor point of view. And I think till the time the Federal Reserve in America says, I'm done with tightening and I'm now going to stop increasing interest rates over the next 18 months, I think equities will remain a volatile asset class. So it is much better for any investor to consider something like multi-assets over equities, because equities will be too volatile for most investors.
Volatility is understood, Naren, and that's part and parcel of an equity investor's life. But in an absolute sense, do you think the risks are stacked against equities for the next 12 to 18 months? I mean, I'm not asking about the fact that markets may go up and down, but do you think there is absolute downside to this market, given where valuations stand today and given the risks that we are talking about?
Actually, if you had asked me this question, I would say yes, particularly for small and mid caps. But what has happened at this point of time is that, the retail investor interest in Indian equities is something I've seen on a scale which I've never predicted before. And, I've seen it in early 90s in India, and after that, I'm seeing it now. So if you ignore the retail investor interest, I would have clearly predicted much bigger falls possible in both small and mid caps particularly. And we at ICICI Prudential have been surprised by the level of retail investor interest in equities. Purely on a valuation basis, we believe that the small and mid caps have more downsides. Large caps have seen such huge selling from foreign institutional investors that valuations on the large cap side is not so high that it doesn't appear that you can see very, very large selling from foreign institutions on the large cap side, or big corrections possible on the large cap side. But it all depends on how retail investors behave over the next 12 to 18 months. Rather than anything. And it has not been easy for us to model how retail investors will behave, because in India, what we have noticed over the recent past is people are more comfortable with equities as an asset class than they are with other asset classes. And if that trend continues over the next 12 to 18 months, then I think the downside is lower, because at some stage, the foreigner is going to come back to India. It's not that the foreigner does not like India. It is just that temporarily they need to pull out money from emerging markets, so they're selling India. But I believe that if I take a 3-year view, at some point of time, India will come back into fashion for the foreign institutional investors, and they'll start investing in India. So if in this period when FIs are selling, if the Indians manage to hold on, I believe at some later stage, the foreign institutional investor will also come back into the buying bandwagon very clearly.
This is an interesting point, Naren, because your point is very well taken that domestic investors have offset the selling by global investors. But in the past, high retail sentiment, when valuations are not very low, has actually been a contraindicator for the market. Markets have actually not done very well in periods where retail sentiment or following periods of very high retail sentiment. Given that small caps and mid caps, where this interest is the highest, and that they have corrected far more significantly, 20-25% or even 30% in many cases in the last 6 months, do you think this patience can get tested? And do you think this time is different in some sense?
One of the words is never use this word, this time is different. So what we did at ICICI Prudential is we started saying asset allocation, because once you say asset allocation, at least it means that people are continuing to be invested at least partially in equities, and they at least stay on being invested in large caps also. Because see, it's tough to predict retail investor behavior, and it's difficult to predict what happens. It's very easy to be saying that the retail investor will one day exit the market, but it's much better for us to say that it's much to be in asset allocation or to recommend multi-assets, because it's tough to predict this. And if you had asked me the reason that, whether markets can go down in small and mid caps, I would say that. But it's much safer to recommend asset allocation and to recommend that if I take a 5-year view, equities is going to do well, because at some stage the foreign investor does not like China, cannot invest in Russia. Brazil is structurally not a great market outside commodities. So the foreign investor, if you take a 5-year view, is going to come back to India. So if an investor has a genuine 5-year view, there is no structural market in BRICS outside India. So that's why it's very nice to recommend asset allocation or recommend equities with a long-term view for investors.
Okay. Naren, you've spoken about perhaps how this is a time to look for value in the market, sectors that may actually see a strong comeback, from real estate to telecom to power. Share with us if there's an underlying philosophy across these pockets, or if something particular is standing out to you right now, and why.
The year 2020, people used to say that quality at any price was a strategy which would work. And, we had an opposite belief, and we had a belief that sectors like metals, telecom, many of the PSUs would all deliver returns because they were looking deeply undervalued relative to the markets. And, the last 2 years has borne us out that, many of these sectors like, metals, for example, or telecom, or many of the PSUs, they have actually done extremely well compared to some of the quality at any price relative stocks. And, as such, our experience in looking at value in a country like India over the last 18 years, since we started our value fund in value discovery in 2004, has been very interesting. That in an 18-year period, there have been 2 years where the fund did very badly, in 2007 and 2017. But otherwise, the experience of the investor has been very good for the long term, and with intermittent phases like 2007 and 17. And we think at various points of time, some of the sectors become extremely cheap. So if you look at auto at this point of time, for example, on a 5-year basis, the sector hasn't done well. And without auto, you cannot move from one place to another. If you look at financials, for example, over the last 5 years, it started to underperform. So again, with financials is something basic. So we believe that these are the sectors which have now become interesting over the next 3 to 5 years. So we believe that, on a continuing basis, there is always something which becomes very relatively attractive for the long term, which has underperformed for a long period of time. Just like at some point of time, metals had underperformed for almost 10 years. And telecom had also underperformed for 10 years, and power had also underperformed for 10 years. So this kind of a framework where you look for areas which have done badly for a long period of time and which we continue to use. For example, we all continue to use metals, we continue to use telecom, we continue to use power. Now we continue to use auto, we continue to use banks and financial services. So that framework is something that we at ICICI Prudential have been using, and it has helped our investors in the long run, although in near terms there are times when it doesn't work.
You're right, Naren, in pointing out this underperformance, and nowhere is it more stark than the blue chips of yesteryear, like the HDFC Bank and HDFC Twins. And for a brief while after their merger announcement, on the day of it, it looked like they were now set to catch up on that underperformance. But once again, they've started slipping and underperforming the market. As a fund manager, you've had experience of owning these companies over long stretches of time. What do you make of this kind of underperformance from one of the bluest of blue chip houses of India in the financial space?
See, we don't talk of individual stocks, but our investing framework requires at ICICI Prudential to look at an long-term intrinsic value of a sector and a stock, and then look at the current value and see whether it is relatively attractive compared to that, and increase the holding of that stock. So 2 years back, for example, metals had reached throwaway prices, and at that point of time, people were more positive on auto than on metals. Our view was auto required the utilization of metals, consumer durable required the utilization of metals, but people believe that auto and consumer durables could be made without metals. So the long-term intrinsic value framework that we had suggested that we have to look at metals instead of looking at auto and consumer durables at that point of time, and that framework is what framework we use across sectors and across stocks at all points of time. And so with that framework, we look at different stocks, and as you know, there is always greed in the market at some points of time, fear in the market at some points of time, and the greed and fear frameworks that come at various points of time is what gives hope to fund managers like us to actually deliver long-term active management returns for many investors, and give investors the benefit of the mutual fund industry. And that is what we work through many of our asset allocation frameworks and various other schemes that we run at ICICI Prudential.
Let me ask you about a sector then, which actually did very well over the last couple of years and then has started waning of late, which is IT. I mean, post the Infosys results, there has been a lot of consternation about margin slippages and whether the rise in valuations that we saw in IT is a thing of the past. I mean, it's a very large sector which fund managers like you cannot ignore. Are you optimistic about it given the rupee's depreciation, or do you think the best is behind?
So at ICICI Prudential, we have different styles. So if you look at my own style, which is more contrarian and value oriented, I moved to an underweight position because the sector had done extremely well and valuations were very high relative to their past. So on the other hand, some of my colleagues were more growth oriented, and they could see that this is one of the sectors which actually can do extremely well in the next few years in terms of growth. So they were positive relative to me, and so they held an overweight position. As an organization, our view is these are some of the best corporate governance stocks in the market with a fantastic long-term outlook. But somewhere, some of these companies, the growth embedded in them was higher than what was implied in their share price, and therefore there was a margin of safety had come down. But with the way the stocks have been correcting, I think sooner or later, some of these stocks will become pretty attractive for us to look at it, even with a value contrarian mindset that I have as an investor. Yeah, whereas some of my growth colleagues who had the stock, they continue to hold the sector in an overweight position. So I think it's a very interesting sector with very good near-term growth characteristics. The issue is whether 3 years from now, the growth rates will significantly come down or only slightly come down. And that's a very complex decision for us to decide at this point of time.
Naren, what about earnings? You have not sounded too concerned while the rest of the market is wondering if not in this quarter, will we start to see the impact of those higher prices in the following quarter? There is some nervousness, some cautiousness, as we can see as well in the kind of volatility the benchmarks are witnessing. Why are you not too concerned?
See, actually, we at ICICI Prudential believe that, there is a deflationary period and an inflationary period. In an inflationary period, what happens is prices go up, and prices are some companies' output. So if you look at the price of steel or oil or aluminium or many of these prices, as prices go up, their earnings go up. And as the output price of steel goes up, you have a situation where the credit growth also goes up because you need to stock up steel. So even the earnings of the financial services companies goes up. So I think earnings is something which is benefited by inflation. So how does earnings get affected? Eventually is that, the central banks come and increase interest rates so much that they cause a slowdown in growth. So that may eventually happen, but near term, I think earnings is going to be not a problem in many of the companies, except the companies which make use of commodities and are not able to pass on the commodity prices. So those are the companies where the near term is more cloudy, but the long term will be good as commodity prices correct. So as such, we are believers that in an inflationary period, earnings is never a problem. So if you look at the period from 2002 to 8, that was a period of high inflation, but that was a period where earnings growth was pretty good. Whereas if you look at the period from 2008 to 2020, that was a period of deflation, and that was a period where perpetually earnings used to disappoint, because that was a period of deflation, which means output prices not being high. When output prices are not being high, the earnings actually is not good, and therefore that was a problem of that period. So I think earnings is not a problem at this point of time, but eventually at some point of time, due to inflation, the central banks react, like what's happening at this point of time in America. And when they react and increase interest rates significantly, that slows down the growth and creates trouble. But that is going to happen in India at some point of time, and that would be the challenge. And that is the reason why we recommend asset allocation at this point of time.
So Naren, let me ask you, given all that you've said, you just spoke about some sectors which are consumers of metals and commodities, and their margins might come under pressure. Earlier you spoke about some sectors where valuations might have been excessive. Keeping all this in mind, which are the sectors that you as a fund manager are underweight on at this point in time?
See, for example, at ICICI Prudential, we have fund managers who are more contrarian, and we have people who are more growth oriented. So, for example, a person like me who has a more contrarian thought process, who is involved in a value strategy and a special situation strategy, clearly being underweight, IT is something that comes. Being underweight, small and mid cap is something which comes naturally at this point of time. Looking clearly at being overweight healthcare, overweight telecom, and overweight many of the oil and gas companies which are benefited out of higher oil prices, for example. These are some of the areas where we have been overweight and underweight at this point of time. So as we feel that the commodity price inflation bites and the sectors have already been impacted, we think that both auto and financial services and banks are the two sectors which are going to look more and more attractive for the long term, which have a near-term problem, and particularly auto. And we think eventually sectors like capital goods also have to have a better benefit, considering they have all come out of a 12 to 13-year downturn cycle. So these are some of the sectors which I think we will have to look at to invest at this point of time and keep increasing sector weightages at this point of time, given that each of them have had their own concerns in the past, but the long-term outlook is good. And short-term, many of them have underperformed, so they give you an opportunity for you to consider increasing weightages at this point of time.
Great hearing your thoughts. As always, Naren, thank you very much for your time today.
Thank you, Naren.
Thank you.
If you like the video, do like, comment, share and subscribe.